According to Reuters, Asian stock markets opened in a cautious mood on Thursday as the fragile ceasefire in the Gulf faced immediate strains, pushing oil prices higher and raising concerns about sustained inflationary pressure. Investors were reminded that the economic fallout from the Middle East conflict is likely to persist as tensions continue to affect critical energy routes. The Strait of Hormuz, a vital artery for global oil supply, remains effectively under Iranian control, with Tehran demanding tolls for safe passage. There is a little indication that the waterway is operating in a meaningful, stable capacity, leaving markets wary of further disruption. President Donald Trump emphasized on social media that U.S. forces would remain in the Gulf until a formal agreement is reached. He warned that if compliance is not ensured, military action could resume. Simultaneously, Israel carried out its heaviest strikes on Lebanon since conflict with Iran-backed Hezbollah began last month, resulting in over 250 fatalities on Wednesday. Financial analysts noted that the geopolitical instability directly influences oil markets. Nigel Green, CEO of the Verve Group, highlighted that roughly one-fifth of the world's oil supply moves through the Gulf corridor, which is still influenced by active conflict. He explained that even without a full blockade, oil markets can react sharply to military activities, especially as missiles continue to be launched and hostilities persist in other regional fronts. Following these developments, U.S. crude future rebounded 3.1% to $97.33 per barrel, while Brent crude rose 2.1% to $96.86. In Asia, Japan's Nikkei index fluctuated around flat after a strong 5.4% gain the previous session. South Korea's KOSPI also remains subdued, while China's CSI 300 index slipped 0.6%. MSCI's broadest index of Asia-Pacific shares outside Japan eased 0.7%. In the United States, S&P 500 and Nasdaq future both fell 0.2% as gain from the prior day's rally dissipated. Europeans market were mixed, with Euro Stoxx 50 future down 0.1%, DAX futures down 0.5%, and FTSE futures up by 0.4%. Rising oil prices, currently around 40% higher than pre-conflict levels, are expected to drive inflation higher. U.S. core price data for February, due later Thursday, are forecast to show a 0.4% rise, even before accounting for the recent surge in energy costs. The International Energy Agency, led by Faith Birol, warned that supply disruptions in the Middle East will likely to begin impacting Europe by mid-April. This has highlighted concerns about global energy security and economic pressure. Minutes from the Federal Reserve's most recent policy meeting revealed that some members are considering further rate hikes to contain inflation, although many believe the next move could still be a rate cut. Treasury yields responded modestly, with 10-year U.S. notes at 4,296% from 3.96% before the attack on Iran. Fed fund futures now imply minimal easing for the remainder of the year, reflecting a retreat from earlier expectations of larger rate cuts. Analysts at JP Morgan noted that the Fed is likely to maintain its current stance, keeping rate on hold for a year. The changing outlook for interest rates has also affected the currency market. The US dollar steadied at 158.68 yen after previously falling to 157.87, while the euro remained flat at $1.1669 off a recent peak of $1.1721. In commodities, gold prices edged slightly higher to $4,721 per ounce, rebounding from a short-term peak of $4,777. Market participants continue to monitor geopolitical tensions, oil price volatility, and central bank policy signals closely, as these factors are likely to influence both financial markets and inflation trends in the coming weeks.